You know, in finance, we spend a lot of time trying to answer what seems like a really simple question. I mean, how do you really measure a company's risk? How do you put a number on it for a giant like Apple, or even your local coffee shop? For any investor, this is, well, it's pretty much the question. And for decades, the financial world has had a go-to answer. It's just one word, one little number that's supposed to capture all the market risk of a company: beta. But here's the thing, and it's a huge problem. The standard way we're taught to find it, the way they drill into you in business school, it's kind of broken. It's so noisy and unstable that it can send you down a completely wrong path. So, if the main tool in our toolbox is busted, what are we supposed to do? Well, it turns out there's a much smarter and honestly, a much more intuitive way to think about risk.
Okay, so to really get why the old way is so flawed, we have to start with this statistical tool called a regression.
The textbook approach is pretty straightforward. You take a stock's historical returns, you plot them against the returns of a market index like the S&P 500, and you draw the best fit line right through that cloud of dots. The slope of that line? Boom, that's your beta. Sounds easy, right?
Well, not so fast. Just look at this. We've got the beta for the exact same company, Embraer, but one was calculated this way, and the other a totally different but still valid way. And look at those numbers. They're not even close. So, which one is the real beta?
And here's the kicker. Neither one is necessarily right. The number you get for beta completely changes based on the little choices you make. Do you use 2 years of data or 5? The beta changes. Do you compare it to the S&P 500 or a global index? It changes again. Heck, even just switching from weekly data to monthly data will give you a different number. The big takeaway here is that all this sensitivity just creates a ton of statistical noise. And in statistics, there's actually a term for this. It's called standard error, and it's basically a number that tells you how wrong your estimate might be.
Now, this isn't just some tiny academic detail. For your average US company, the standard error for its beta is about 0.20. That might not sound like a big number, but let's see what that actually does to our estimate.
So, let's say your fancy regression spits out a beta of 1.1. With that standard error, what you're really saying is the true beta is somewhere between 0.7 and 1.5. I mean, come on. That's not an estimate. That's a massive gaping hole of uncertainty. Is the company safer than the market or 50% riskier? The regression basically says, I don't know, somewhere in there. It's almost useless. And you might think, okay, I'll just find a regression that looks really good statistically, one with a high R-squared. But it's often the opposite. There's a famous story about Nokia back when it was like 80% of the entire Finnish stock market. A regression against the Finnish index looked perfect, but it was just a regression of Nokia against itself. It told you absolutely nothing about its real risk to a global investor.
And this is exactly why we need a complete shift in thinking. We have to stop seeing beta as just a statistic from a chart. We need to understand where it truly comes from, the fundamental business itself.
A company's risk isn't born from a regression analysis. Nope, it's the direct result of the choices its managers make. What business are we in? What's our cost structure? How much debt are we taking on? Those are the things that create risk.
So we can boil it down to 3 core drivers. Number 1 is the type of business you're in. Number 2 is your operating leverage, basically how high your fixed costs are. And number 3 is your financial leverage, how much debt you have on the books.
Let's just take that first one, the business type. It's so intuitive. The more discretionary your product is, meaning the easier it is for customers to just not buy it when times are tough, the higher the beta. A grocery store sells stuff we all need, so it has a low beta. A luxury jeweler sells things we want but can definitely live without in a recession, so it's going to have a much higher beta. It just makes sense.
So, if risk really comes from these fundamental building blocks, can we actually build a beta from the ground up? Yes, absolutely. And that leads us to a much, much better approach.
We call it the bottom-up beta. Here's how it works. First, you totally ignore running a regression on your one company. Instead, you figure out all the different businesses it's in. Then you find hundreds of other publicly traded companies that are in those same businesses. You grab their betas and you average them. This is the magic part. All that statistical noise starts to cancel out. Then, and this is key, you mathematically remove the effect of debt from that average. This is called unlevering. And only at the very end do you adjust that pure business beta for your company's unique business mix and its own specific debt load.
Okay, I know. That sounds like way more work than just clicking a button to run a regression. So why bother? What's the real payoff?
It all comes down to the law of large numbers. I love this quote. You can take 100 rotten betas, you can average them out, and the average is going to be magically precise. Think about it. Any single company's regression beta might be junk, way too high or way too low because of all that noise. But when you average hundreds of them together, the individual errors just wash out. They cancel each other out, leaving you with a really solid, precise number.
So precision is the #1 advantage, for sure. But the benefits don't stop there. This bottom-up beta reflects what the company looks like today, not what it was 5 years ago. And get this, you can even use this method to find a beta for a private company that doesn't even have a stock price. It's also adaptable. If you know a company is about to make a big change, you can build a forward-looking beta that reflects that future. Try doing that with regression.
Let's look at a real example, like SAP. We see it's really in two businesses, software and consulting. So we find the average industry risk for each of those, and we unlever them to get to the pure business risk. Then we just weight them based on how much of SAP's value comes from each part. You can see it's mostly software. That gives us SAP's core business beta. And for the final step, we just relever it, adding back the effect of SAP's very specific low debt load to get our final, much more reliable number. And we did it all without running a single noisy regression on SAP itself.
So, you see, beta isn't just some number that a computer spits out of a black box. It's a story about a company's real-world business risk. And yeah, the standard way of finding it is, well, it's a mess. But if we build it from the ground up, from the fundamentals, we get something that's way more precise, way more current, and frankly, just makes a whole lot more sense. So that leaves me with one final thought for you. The next time someone hands you a beta, you'll know exactly what to ask. Yeah, but where'd you get it from?